On July 24, 2026, panic hit the tape for American Express. Following the release of their Q2 earnings, the stock plummeted 5.58%. They are plowing all that excess cash generation back into customer acquisition and technology, rather than allowing those dollars to boost near-term profits. This creates a divergence in interpretation. Either the market identified structural margin deterioration, or Wall Street is mispricing a company that is deliberately paying the heavy cost of maintaining its moat. This line graph tracing American Express's total net revenue explains why they have cash to spend. From a baseline of $43.5 billion in 2019, they have scaled to $72.5 billion in 2026, delivering a 13.6% compound annual growth rate. They achieved this growth while keeping delinquency rates pinned between 1.2 and 1.3%. Because the model doesn't require massive injections of retained earnings to fuel that top-line growth, their return on equity has expanded to 36%. The Federal Reserve validated this resilience in their June 2026 stress test. Under a scenario modeling a 10% unemployment spike, American Express was projected to maintain a positive pre-tax net income rate of 3.8%, while direct consumer finance peers faced severe capital depletion. This flowchart illustrates the architecture behind that stability. Visa and MasterCard operate open-loop networks, acting as bridges between banks. American Express operates a single closed-loop network, acting simultaneously as the card issuer, the payment network, and the merchant acquirer. Controlling the entire transaction lifecycle yields immense pricing power. It is the specific mechanism that allowed them to hike the annual fee of the flagship Platinum card by 29% to $895. Customer attrition remained near zero despite the price increase. The company has captured millennials and Gen Z, who now make up 60% of new accounts and drive 35% of all U.S. consumer card spending. The closed-loop architecture and affluent demographic base act as a high-interest rate buffer, protecting the company from the credit decay currently hitting traditional consumer lenders. That missing earnings cash flows directly into the variable customer engagement ratio, or VCE. Management currently recycles up to 45% of every dollar earned back into the ecosystem to reward cardholders. Maintaining near-zero churn among high-spending customers requires physical capital. This includes funding rapid global expansions of Centurion lounges and absorbing the heavy payout structures required to maintain co-brand partnerships with Delta Airlines. It also includes securing a functional monopoly in global luxury dining. In Q2 2026, American Express spent $700 million to acquire TheFork, merging it with Resy and Talk to lock high-net-worth diners into their network. Beyond dining, they are deploying artificial intelligence through the Agentic Commerce Experiences Developer Kit. This framework allows autonomous AI bots to make purchases and book travel for cardholders using tokenized payment credentials. To address the liability dilemma of AI spending, they rolled out an industry-first fraud protection guarantee that shields consumers from charges resulting from registered AI agent errors. This aggressive spending brings friction. Non-interest expense is growing at 12% year-over-year, and pre-tax losses are widening in the corporate middle market as they fight off fintech competitors like Ramp and Brex. The primary existential threat is regulatory. If the Credit Card Competition Act passes and compresses interchange rates across the industry, merchants will pressure American Express to lower its own merchant discount rates, threatening a severe margin squeeze. Flat EPS guidance serves as a necessary financial offensive, funding a walled garden to withstand both rising fintech competition and the looming threat of regulatory margin compression. Stripping away the quarterly noise reveals the firm's true value through a Damodaran-style, three-stage free cash flow to firm intrinsic valuation. This identifies the objective floor of the stock's worth. This spend-centric model generates cash with the efficiency of a technology processor, bypassing the heavy leverage requirements of a traditional commercial bank. This matrix displays the exact base case inputs for the math. We begin with a 4.20% normalized risk-free rate and an initial weighted average cost of capital of 8.21%. We then map 10% revenue growth against a steady 21.5% operating margin. Projecting those operating cash flows out over 10 years generates a $245.5 billion enterprise value. To find the equity value, we take that enterprise number, add the firm's $45.2 billion in cash, and deduct $57 billion in total debt. dividing by the outstanding shares gives us an implied intrinsic value of $344.15 per share. Following the earnings panic, shares traded in the $326 to $340 range. Against the objective math of its cash generation, the post-earnings sell-off created a clear valuation discount. Wall Street's fixation on quarterly EPS targets ignored the transition under the hood, the evolution into an AI-augmented lifestyle platform that is aggressively funding its own compounding machine.